Welcome everybody to ACA Reporting 101. I'm sure this is a webinar that you've been looking forward to or not looking forward to, but at any rate, it's necessary and we're doing it, and we're gonna go ahead and dive in. First and foremost, just want to thank everybody for taking time during your lunch hour to attend the webinar. This was originally a lunch and learn webinar that we've done for several years, where we brought people into the office. That's obviously not happening because of COVID. However, the time didn't change. We will think about in future years adjusting the time so we're not interrupting your lunch. But at any rate, welcome. My name is Keith Dunlop. I'm the Director of Compliance with Morrison Garritano Insurance. Been with the agency in that role for almost 7 years. My primary responsibility is helping our clients with everything related to healthcare compliance, ERISA, DOL regulations, IRS regulations, and importantly, all of the Affordable Care Act requirements, including what we're going to talk about today, which is your annual ACA reporting. For several years, we've done a specialized session of this training for people that are using Employee Navigator, and that was focused really on how to use the platform for processing your 1095 reporting and transmitting to the IRS. But we've never done one focused on clients that are using something other than Employee Navigator, like payroll services, for example. And I noticed in looking at the approximately $1.7 million worth of proposed penalties that our clients have seen between 2016 and 2018, that the drivers of those were primarily two things. One, errors in the ACA reporting, and reporting done by third-party vendors that had not been audited. So that's really where this webinar was born. It's focused on a granular look at how you complete the 1094-C form and the 1095-C form, and how to self-audit that information if you're having a third-party vendor prepare it so that it's correct before it gets into the hands of the IRS. So this is our roadmap for today. We'll talk briefly about who files what and what the current deadlines are. I don't have a legislative update this year like I have in years past, because there's no current ACA lawsuits going on, but I am going to talk about some very significant changes to penalties and IRS enforcement. We'll take a look at Form 1094-C and how to fill that transmittal form out, obviously 1095-C, and then we're going to do a pretty deep dive on the 1095-C coding, what the codes mean, when to use what codes, what code combinations make sense, and then we'll do some practice auditing of some sample 1095-C forms to practice what we learn. And so starting with who files what. So if you're an applicable large employer, and that's employers with 50 or more full-time and full-time equivalent employees in the prior calendar year, you have your employer mandate responsibility and your ACA filing responsibility. That's Forms 1094-C and 1095-C. I often get questions about, well, what do the insurance carriers do, and do they do this for us? And the answer is no. So insurance carriers have their own separate ACA reporting responsibilities with the B series form. Applicable large employers have to file the C series form. So oftentimes your employee is going to get two separate forms, one from the carrier and one from you. And that's going to lead us to our first poll question, I think, Sarah. So we're going to throw up a couple questions at you today. And the first one is, did you know that California has a health coverage mandate? Yes or no? All right. Okay, we've got 2/3 of the group answering, and I'm happy to see that most people believe that yes, we do have a health insurance mandate, and we do. So starting in 2020, as a result of the Trump tax bill doing away from the federal insurance mandate, many states instituted their own state-based mandate. California was one of those states. So if you reside in California, you're required to have health care insurance, and the Franchise Tax Board will penalize you if you do not maintain coverage. The reason why I'm talking about this here is that the Franchise Tax Board also wants 1095-C data. They want the 1095-C information that goes on the form that you fill out. However, there's a huge caveat to this. Only self-insured employers are required to file the 1095-C data with the FTB directly. If you are a fully insured employer, which is everybody in this room, you do not have to file your 1095s with the Franchise Tax Board. That information is going to go directly from the carrier to the Franchise Tax Board. You don't have to deal with it. However, there's one little wrinkle here. In the instructions from the Franchise Tax Board, they mandate that employees must receive their forms by January 31st every year. And this conflicts with the federal due date. The federal due date this year is generally January 31st, but this year, as in prior years, the IRS has provided an extension. So under the federal guidelines, you have to provide your forms to employees by March the 2nd. However, if you have California employees, those forms have to be provided according to the Franchise Tax Board by January 31st. So we're encouraging everybody to get this filing done as early as possible, and certainly before January 31st. If you want a reference to that, I've included the Franchise Tax Board publication number here for you. And then transmission to the IRS, if you're transmitting electronically, the due date is March 31st, and if you're mailing paper forms to the IRS this year, that deadline is February 28th. So a brief penalty update. The ACA penalties increase every year. This slide provides a variety of different penalties for different things under ERISA, but I've highlighted the two important ones that are relevant to what we're talking about today. The A penalty for failing to offer health care coverage, and the B penalty for failing to offer affordable health care coverage. Those have both gone up. You see the value of those penalties here, and how this looks to an average employer is such. So an employer with 75 full-time employees that fails to offer coverage that meets minimal value to at least 95% of their full-time staff and dependents, and if just one of those employees gets subsidized coverage at Covered California, you get this, you suffer this A penalty from the IRS. You get credit for the first 30 employees. So in this situation, you're going to pay that $2,700 per month times 45 employees, or a sum total of $121,500. So as you can see, these A version penalties get very big very quickly. And so this is really the driver of why we do education like this, to make sure that employers know their obligations and are doing their obligations correctly. I really want to talk about some major changes to IRS enforcement to the penalties. There was a Treasury IG report in June of 2020 which evaluated the IRS processes for collecting ACA penalties. This report was highly critical of the IRS collection efforts to date, and pointed out that of the $17 billion in proposed penalties, I mean, just look at that number for a second, $17 billion in just a 2-year period of time that the IG looked at. The IRS only collected $749 million of that, and so because of that, the IG recommended increased enforcement efforts. Projected Penalty revenue for ACA failings is $13 billion in 2017 and $15 billion for 2018. Also, on top of this, the Biden administration has increased the budget for enforcement of the IRS 10.4%, as you see here. On top of that bad news, there's further bad news on enforcement. Up until now, the IRS has provided good faith relief to employers who make a reasonable effort to comply with the obligations. If you fail to meet your ACA obligations, if you were able to at least demonstrate a good faith effort to attempt to be in compliance, you largely were given relief from many of the penalties. That relief has now ended with the 2000 tax year, meaning as of this current 2021 tax year, all of those good faith relief provisions are now gone. This just emphasizes the need to be really diligent about that the ACA reporting is being done timely, and is being done correctly. In addition to the penalties for failing to offer coverage and also failing to offer affordable coverage, there are other penalties that people are often not aware of, and this has to do with the filing of your reporting. There's two sections of the Treasury Code which have separate penalties attached to each. One is for failure to file on time with the IRS, and the other is failure to furnish forms to the employees. The penalty is $280 per form, but it's really more a $560 fine because you get penalized twice. If you fail to file your ACA reports, the IRS assumes you also have not furnished forms to your employees. So it's a double whammy penalty. And this penalty gets really big really fast too, and I've seen this a couple of times now. There are limits, however, to the penalties, although the limits are quite high. So if you're a small employer, the cap on these penalties is $1.1 million. If you're a large employer, it's a little over $3.3 million. The definition of small and large in this context has to do with your gross earnings. I think it's 5 million gross earnings to qualify as a small employer. But the moral here is that there are more penalties to be concerned with other than just failing to offer and failing to offer affordable health care coverage. And lastly, bad news on the penalty front is that there is no statute of limitations for any of this. Normally, there's a 3-year statute of limitations on tax returns for the IRS to go back and assess penalties. However, the courts have determined that ACA reporting is not a tax return. Therefore, there is no statute of limitations. The IRS can go back as far as it wants to go back, and ACA reporting started in 2015, which means the IRS can still go back that far to try to collect penalties. The concerning part of this for me is that there could be situations where an employer maybe got an A penalty for failing to offer coverage for a prior tax year, got relief from that, and thought, okay, we're good, we don't have to worry about those past years. But my concern is the IRS can still go back to those past years for the B penalty, which is the one for not offering affordable coverage. So just be aware of that. Because of all this, it's critical to make sure your ACA reporting is timely and accurate. Audit everything that's done by third-party vendors. Correct any inaccurate information as quickly as it's discovered. Keep copies of everything for audit and defense purposes. When your third-party vendors prepare and transmit the documents, make sure you are pulling those documents off of the portal, off of whatever system you're using, and keeping those separate for yourself. And keep records of your benefit plan. You may have to prove to the IRS what your contribution strategy is, how you calculated your affordability safe harbor, that you offered benefits that met minimal essential coverage requirements, all of those things. So keep your packets, keep all the information about your benefits. So we're going to look at Form 1094C here. Before I move forward, I do want to say that I want this webinar to be very interactive and informative and get all your questions answered. I know one of the frustrating things for me sometimes as a attendee is not being able to get questions answered. So before I move on to the actual form review, does anybody have any questions about what we've covered so far?
I'll just add, Keith, that people can drop their questions into that Q&A feature, and we'll address them there.
And I don't see any questions, and so I'm going to go ahead and move on. All right, so Form 1094C, this is your transmittal. This is somewhat analogous to a W-3, which is the transmittal for your W-2 earnings information. This provides the IRS with information about the company. Part 1 of the form is fairly basic and simple: name of the company, address, tax ID number. Make sure this matches any of your other tax filings with the IRS. It should be identical. You're asked then a series of questions. Oh, and before I get to that, so sections 9 through 16, nobody in this room is a governmental entity, so you are not required to fill that part of the form out. Question 18 asks you the total number of 1095-C forms that are submitted with this transmittal. It's possible that you may be filing more than one 1094-C if you're maybe submitting corrections for a prior year. This question is about how many forms are going with this particular transmittal. Question 19, is this the authoritative transmittal? 99% of the time, this box should be checked. The answer to the question is yes. The reason why this is even a question is because you may have different subdivisions within your company, and for whatever reason, you may choose to file separate 1094s and 1095Cs for each division, even though it's the same company. In that situation, one of those has to be the authoritative transmittal. That's what this question is asking you.
Keith, we did have a question come through the chat, if you don't mind.
Oh, yes. Let me go there. We have 10 employees and offer coverage through Anthem to our full-time staff. Does this apply to us? So if all you have is 10 employees, no. ACA informational reporting is only required of applicable large employers, and that's employers that have 50 or more full-time and full-time equivalent employees in the prior tax year. So this does not apply to you. And Bruce, if you want to drop off the webinar at this point, then you're welcome to do so, or hang out. But no, if you only have 10 employees, none of this applies to you. Okay, moving on. So question 20 of the 1094 seems to be a duplicate question of the one previous, but it's asking you how many total 1095Cs are you filing. In most cases, this will be the same number as the other question unless you're doing corrections. Question 21 is a really important question, and I do want to spend a couple of minutes talking about this and providing some understanding about what this question is about. If you are in a controlled group, meaning you have multiple entities that have the same common ownership, you are considered an aggregated applicable large employer group of multiple entities. If that is the case, you must answer yes to this question to inform the IRS that you are part of a controlled group, part of an aggregated ALE group. In those situations, each member of the controlled group has their own individual ACA filings. So each member has its own set of 1094s and 1095s. A controlled group is governed by Section 414, and this is not going to be a webinar about control groups, but just to briefly, so that there's understanding here. If you have common ownership between multiple entities, pursuant to the 414 regulations, you are a single employer for purposes of ACA compliance. And that means both offers of coverage of insurance, offers of affordable coverage, and completing your ACA reporting. So just for example, you may have a company with 60 full-time employees that's clearly an applicable large employer, and another company that's connected through common ownership that maybe only has 10 full-time employees. You may think that company with 10 full-time employees does not have to comply with the ACA mandate and the ACA reporting, but because of the connection through the controlled group and the common ownership, that's now one large company that has to comply with everything. So that's why that question is really important. The other area where I get a lot of questions on is the certifications on line 22, specifically the qualifying offer method. What is a qualifying offer method? Do we have to check this? Do we not check it? What does it mean? Qualifying offer method is a special kind of insurance offer, which really is defined by the cost of coverage to the employee. If you're making an offer of coverage which meets the ACA standards for minimal essential coverage to the employee, that costs no more than the affordability percentage of the federal poverty earning level for that tax year, that's a qualifying offer of coverage. For 2021, the Fed poverty level was $12,880, and 9.83% of that on a monthly basis is $105.51. So if your offer of coverage meets MEC standards, is offered to the spouse and dependents, and is below that $105.51, you are making a qualifying offer of coverage. And then you get to do alternative reporting on your 1095. The alternative reporting means that you don't have to provide the IRS with a lot of the data you normally would have to provide on the 1095-C. You don't give the IRS any cost of coverage information, and you don't have to provide the IRS with any information on line 16 of that form, which we're going to look at in detail in a minute. The code on the 1095s that signifies that you're making a qualifying offer of coverage is code 1A, which shows up on line 14 of your 1095s. If you've got code 1A showing up on your forms for at least 12 months for at least one full-time employee, you are then making a qualifying offer of coverage, and you are then you are then required to check this box to alert the IRS that you're using code 1A on your 1095s. So the takeaway here is, if you're using code 1A on your forms, you have to check this box to alert the IRS that you're using qualifying offer reporting. If you are not seeing 1A on any of your forms, this box stays unchecked. And the primary driver is the cost of coverage to your employees. So to finish up with 1094-C, this is probably the single most important question on your 1094-C. It shows up on the second page under column A, minimal essential coverage offer indicator. What does that mean? This is a question, and the IRS is asking you, have you met your employer mandate of offering affordable coverage to at least 95% of your full-time staff that meets minimal essential coverage requirements, yes or no? If you answer no to this question, you are telling the IRS, we have not met our mandate. This needs to say yes. And the primary errors that I see in ACA reporting from third-party vendors is where these indicators say no for certain months because of inaccurate HR data that's in the system. The second this says no for any month, and any employee ends up at Covered California for subsidized coverage, you're guaranteed a penalty notice from the IRS. Now, I'm not suggesting just this says yes automatically. If it's technically accurate that you failed to meet that 95% offer threshold for any specific month, you obviously have to provide the IRS with accurate information. But know that this is a primary driver of the penalties under the ACA. The rest of the form is pretty straightforward. Column B, your full-time employee count for the given month, and then your total employee count, that's full-timers plus part-timers, in column C. If you answered that aggregated ALE question on the first page, yes, the IRS wants to know which month or months you were in a controlled group. And then finally, if you were in a controlled group, the last page of the form requires you to provide the IRS with the name and the tax ID for the other companies that are in that same control group. And with that, I'll pause again here and take questions. I see a couple up here. What if you also select the 98%? Yeah, so I get questions about that 98% box as well. There's really no benefit in checking that box. The only real benefit of checking that box is that the IRS permits you to not complete the, let me go back to that screen here. It allows you not to complete column B, the full-time body count, on page 2 of the 1094C. There really is no other benefit to that, and so I don't really recommend that employers check that. It doesn't really do anything. This is only for an offer. We offered 3 full-time employees healthcare, 1 declined. So yeah, the purpose of the ACA reporting is just to prove to the IRS that you made your offer of coverage. It's the employer proving that you've met your mandate. The IRS doesn't really care if the employee has accepted the offer or not, but they do care if you've met your mandate. When we look at the actual completion of the 1095 and go through some of the codes, we're going to talk about what codes might go in the 1095 in situations where the employees waive coverage. But that's not the waiver is not data that the IRS is all that interested in. Let's see, other questions. Is there a report in Navigator that can give the headcounts and data to complete the report? So the great thing about Employee Navigator is that Navigator populates all of this data automatically, providing that it's been fed all the accurate HR data. There is no report to import the headcounts in columns B and C here because that information goes in there automatically. Okay, and so no other questions on that. We're going to move forward. So the 1095C, here's your form. This is a 2020 version, but nothing's changed. I'm just pointing out here that there are 2 new data fields on the form, the employee's age and a zip code for the employee's address. These are specific to employers that offer special HRAs, individual coverage HRAs. I don't know of anybody in this room that does that, so we're not going to spend much time on those issues. Part 1 of the form, again, super straightforward. The employee's name, social security number, employer's name, and tax ID number, addresses. Clearly make sure the employer data matches what's on the 1095C. Here's part 2 of the form. Most of our webinar today is going to be a deep dive on this section of the form, how it's filled out, what the codes mean, what code combinations make sense, what codes not to use, and what are the penalty drivers. The new codes, again, they're specific to the new forms of HRAs that came out in 2020. I am not going to cover those codes in this webinar. If anybody wants to have more of a discussion about these, contact me after the webinar. And Jacob, yes, so the slides, the full slides and recording from this will go out afterwards, so if you have to step away, please do. Thanks. Part 3 of the form, This section is filled out, again, only if you are self-insured. If you have a fully insured fully insured medical program, you are not filling out this part of the form. So only if you're self-insured. The IRS wants the names of all of the individuals who are covered under the employee. For people that are self-insured and don't fill this out, this information gets to the IRS by way of the insurance carrier on their reporting. So this is all about the employer mandate, as I've stated. An applicable large employer, one that has 50 or more full-time and full-time equivalent employees during the entire prior calendar year, has to offer coverage to their full-time staff, those folks earning or working rather 30 or more hours per week, and their dependents. The coverage offer has to meet minimal essential coverage standards. Those are all the things that the ACA says medical now has to address, and it has to meet minimal value. That's an actuarial number which dictates that carriers have to spend a certain percentage of the premium dollars on actual care versus administrative costs. The sole purpose of the 1095-C is for the IRS to police and enforce this employer mandate. When I talk about the codes that go on the 1095-C to clients, I talk about the fact that the codes tell a story. I can look at just the codes on the 1095-C and know when an employee was hired, when they were eligible for coverage, and what they did with that coverage offer. The codes on the form help the IRS by enforcing the employer mandate to offer coverage, and they also enforce the employee's eligibility for that subsidized coverage on Covered California. If an employer is offering affordable coverage to a full-time staff person, they are not eligible to get subsidized coverage from Covered California. The 1095-Cs help the IRS enforce that. The codes on the 1095-Cs each and every month of the tax year answer the following questions. Was the employee offered ACA compliant medical coverage? What was the lowest cost of coverage for employee-only medical? Did the employee enroll? If the employee waived coverage, was that coverage affordable? And if the employee was not offered coverage, why not? You're required by law to offer health care coverage to your full-time staff. So if you have any month of the calendar year where you're not offering coverage, you have to have a really good reason why that coverage is not being offered. And we're going to talk about that when we look at the actual codes. Let me take a bit of water here. Hang on for 1 second. So here's a summary of the 1095-C codes. There is also a coding cheat sheet in your handout starting on page 14. These are all of the Series 1 and the Series 2 codes, except for those codes that are special to HRAs, which we're not going to discuss in this webinar. I've highlighted the ones in red that are most typical. These are the ones that I would expect to see most often on a 1095-C. Code 1A, meaning you're making a qualifying offer of coverage. Code 1E, meaning you're making an ACA compliant offer of coverage to the employee, a dependent, and a spouse, which is most common. 1H, that there's no offer of coverage being made for that particular tax month. And then the Series 2 codes. These pair up with the Series 1 codes, ideally in ways that make sense. For example, Code 2A, the employee was not employed. In a particular month, you could not be making an offer of coverage to someone who doesn't work for you. So you would report to the IRS, you made no offer of coverage, and the reason why is that the employee doesn't work for you. They're not employed. That makes sense. Code 2C, the employee is enrolled in coverage. I might expect this to be paired with Code 1E after an offer of coverage is made. Code 2D, this is if you look at the instructions, it's called the limited non-assessment period. It's IRS code talk for a waiting period. Either the employee is in your standard waiting period, or they're a variable hour employee that still is in their 12-month look-back period. You're not subject to ACA penalties during those periods. So I may expect to see no offer of coverage 1H paired with 2D because the employee is still in their waiting period. And then I've highlighted in green the affordability safe harbor codes, which we're going to talk about in a little bit more detail on the next slide. These are the codes that would be put on the 1095-C in situations where the employee has waived your coverage, but you're demonstrating to the IRS why your offer of coverage was affordable. And you pick one of the three affordability safe harbors to tell the IRS which one you are using. Before we get to the safe harbors, though, I do want to point out that there are certain codes on the 1095-C which are drivers of potential penalties and describe situations that actually violate the ACA employer mandate. For example, Code 1B, an offer of coverage to the employee only and to nobody else. This violates the mandate because you have to offer coverage to both the employee and child dependents. Code 1D, offer of coverage to the employee and spouse but not dependents. Again, you have to offer coverage to the employee and dependents. Many employers do offer spouse coverage, but that's not actually required by the ACA. Spouse coverage under the ACA is optional. Code 1F, an offer of coverage that meets minimally essential coverage but not minimal value, that actuarial figure. ALE employers are required to offer coverage that meets both MEC and MV requirements. Morrison Garritano does not sell medical insurance that does not meet these requirements. And then 1H, this isn't necessarily wrong, but if paired with the wrong Series 2 code, 1H can be used improperly and can drive penalties. It should always be paired with an appropriate Series 2 code, either 2A, 2B, 2D, 2E, or an affordability safe harbor code. And we're going to go over these again in some detail as we get deeper into the webinar. And you also have your handout, which provides definitions for these codes. So the affordability safe harbors. You have to choose you have to choose one affordability safe harbor to use for a class of employees across the board. The requirement is that you offer affordable health care coverage to your employees, and the definition of affordable is the percentage, the affordability percentage of the employee's household income. You're not going to know the employee's household income, so the IRS gives you three potential safe harbors to demonstrate why your offer of coverage is affordable. The first is Fed poverty earnings. It's simply a monthly calculation based upon the current FPL level for that tax year. For 2021, it's $12,880, as we've already demonstrated, and the affordable level for that for the employee is $105.51. Rate of pay safe harbor is probably the most common one that we use in terms of establishing cost sharing for employers. It's based upon the employee's hourly rate of pay. For 2021, if we use $14 per hour and the affordability percentage of 9.83%, we come up with $178.91, meaning the cost of coverage to the employee while using rate of pay safe harbor has to be below that. I get asked why we calculate that by 130. This is a statutory calculation. 130 is the monthly equivalent of hours of service for a full-time employee by IRS dictate. Finally, we have W-2 safe harbor. This is a little bit more complicated because it takes into account the employee's annual gross earning number on their W-2, but that's adjusted. So So if you have an employee that hasn't worked for you for the full 12 months out of the year, you have to adjust that W-2 number to account for the number of months that the employee is eligible for coverage and the number of months the employee works for you. So we're not going to do any of this math here in this webinar. The slide's here for reference, but in this particular calculation example, it shows that for somebody whose W-2 earnings were $15,000 that worked for only 8 months out of the year, their offer of coverage is affordable. All right, folks, welcome back. Sarah, is my audio still up? I took my AirPods out for a minute.
Yep, you are good to go. And it looks like we had a couple of questions come in during that break.
Yeah, I saw that. So let me read this one. Per the employer mandate, you mentioned that we are required to make an offer of coverage to employee plus dependents or employee only. Is that correct? So the mandate is for you to offer coverage to the employee and dependents, not just to the employee. If it was only to the employee, that would violate the ACA mandate. And Kimberly asks, if an employee waives insurance, is it okay to put 1A on line 14 and leave line 16 blank? Kimberly, you're skipping ahead in the webinar. We are going to look at that specifically, and your question is going to be answered in about 10 minutes, so hang in there. All right. So let's, here's what we're going to do for the next about 30 minutes or so. This is really the main purpose for this webinar, is to give you some practical practice in how to fill out, how a properly filled out 1095-C would look like. I'm going to provide you with some sample problems to work out, and we're going to audit forms. We're going to look at forms that have obvious errors and how to audit those forms and see what those errors are. So you can do whatever is most comfortable. If you've got a 1095 or two in front of you and a pencil, feel free to play along and fill out those boxes with us. Excuse me. Okay, TV announcer cough mode there. So grab pencil if you want and a piece of paper and sketch out some of this stuff with us, or just watch as we go along. But what we're going to do is we're going to actually look at, based upon specific HR facts, how a 1095-C might be filled out. So here we go. This is an example of what a typical 1095-C might look like. This is a correct form. This is an employee who was hired in April as a full-time staff person. The company has a waiting period of the first of the month following 60 days of employment, which is fairly common. The company offers ACA compliant coverage. The low cost is $125 for employee-only enrollment. The employee in this case is enrolled in coverage, and then they quit in November. So starting in January, we see that there's no offer of coverage, and the reason is code 2A, which means the person's not employed. I do get asked often, well, if an employee only started working for us mid-year, do we have to code the rest of the form that the employee did not work for us? The answer is yes, and this is how you would code those months. You can't make an offer of coverage to somebody who doesn't work for you, but you also have to prove, you have to demonstrate to the IRS that you met your employer mandate. So you tell the IRS, we did not offer coverage in these months, but the reason why, for the first 3 months in this example, is the employee didn't work for us. In April, the situation changes though. The employee now works for you. They are your employee and they are a full-time employee. However, you're still not making an offer of coverage at that point because you have a waiting period. So there's no offer of coverage, but now the reason has changed. And the reason is that the employee is now in your waiting period first of the month following 60 days. So 1H, no offer of coverage, is now paired with 2D, the employee is in the waiting period. And so that condition then remains through June. And then after the waiting period is done, now we have, as of July, the employee is eligible for their offer of coverage. So we see 1E, which means coverage was offered to the employee, a dependent, and a spouse. It cost the employee $125, and the employee enrolled, 2C. One comment about the cost of coverage is that the only information the IRS is concerned about is what would it cost for the employee only to enroll in the cheapest possible option for just employee medical. You may offer a bronze, a silver, and a gold plan, and the bronze is the least expensive, but the employee picks the gold and pays for the gold. You don't put the gold prices on this form, you put the low-cost bronze prices on this form. Likewise, an employee may buy up to add a dependent, to add a spouse, and may actually be paying more for the insurance, but you only put in the lowest possible cost for employee-only coverage on line 15. And then in this situation, this condition remains until the employee quits in November. Insurance coverage lasts until the end of the month of termination, so we still have 1E, 2C in November, but now we've got to change. Now in December, the employee doesn't work for you anymore, so now we're back to 1H, no offer of coverage, paired with 2A, the person's not employed. Question, employee moves from full-time to part-time. Yes, we're going to have an example of actually the opposite, where you have a part-time person working for you who then moves into full-time, and that situation you'll see can go the other way as well. Any other questions before we try some actual practice of this? So we've got quite a few practice problems, 17 in total. Some of them will go very, very quickly, so don't be concerned about the number of them. There are going to be some assumed facts that apply to most all of them, and they are that the employer is offering ACA compliant coverage. The waiting period for the employer is first of the month following 60 days. 2021 affordability percentage is 9.83%. FPL earnings are $12,880, and for this purpose, we're just going to play with the rate of pay safe harbor. So all of these examples assume rate of pay safe harbor, and then employees are being paid $14 per hour, which was minimum wage last year. Okay, here we go. First test scenario. Employee is eligible the entire year, enrolls in coverage that costs $125 for a calendar year plan. What might that 1095C look like? Give you a couple seconds to think about that. So here we are. In this case, we get to use the all 12 months box because the condition of the offer and enrollment does not change for the entire year. So here we have 1E, the offer of coverage that's to the employee, spouse, and dependents. Cost is $125, paired with 2C, the employee is enrolled in coverage. Pretty straightforward. Okay, here's number 2. Same basic problem, except now there's a difference in the cost of coverage to the employee. What might this form look like? Same basic form, the only change is the cost of coverage, and it's still affordable. If you run $14 per hour at times 130 times 9.83%, you get $178.91. So this is still an affordable offer of coverage using rate of pay safe harbor. Okay, number 3. The employee is eligible the entire year, is enrolled in coverage that costs $120 for employee-only coverage, but the employee adds a spouse and a dependent with dental and vision coverage, and now the total cost of the monthly cost of the employee is actually $250. What does this 1095-C look like? So again, the cost of coverage is only concerned with the employee. It's not concerned with spouses. It's not concerned with dependent cost. It's not concerned with dental or vision. This is only a form that reports on medical. And again, the employee can buy up to a richer plan or can buy up to add a spouse or dependents, and that cost is not factored into the 1095. And I am keeping an eye out for any questions that come up on each of these examples. So if you have specific questions on these specific examples, go ahead and ask your question and we'll address those here in real time. Okay, number 4. Employees eligible the entire year enrolls in coverage that costs $105 for employee-only coverage, calendar year plan once again. Then the employee had a qualifying event and dropped coverage as of September 1st. What does this 1095-C look like? And a little hint, the key here is the cost of coverage. What kind of offer is this? So here's our 1A code. So this is a qualifying offer of coverage because 105 is below that FPL calculation for the cost of coverage. So we have 1A for all 12 months because the employee is eligible the entire year. We have no data on line 15 because the IRS regulation says do not put 105 in there. But the employee was enrolled at some point, and so we have 2C on months January through August, and then he or she drops coverage, and so that enrollment code drops off for September through December. Now, I want to talk about 2C in this context for just a moment. Remember, I told you early on that the IRS does not require any information on line 15 or line 16 when you're making a qualifying offer of coverage. So some of you might be asking, well, then why is there 2C on this form? Does that have to be there? It doesn't have to be there. It's entirely optional. This form would be a totally correct form if the only thing shown was the 1A in the all 12 months box and nothing else. However, for auditing purposes and just for a visual note that the employee was enrolled, I like to see that 2C only because it tells me that. So it's optional. It doesn't have to be there, but it's not wrong to put 2C on this form in this situation. And so to Veronica's question, yes, so the 1A is there instead of 1E because the affordability safe harbor is FPL, but more importantly because this is a qualifying offer of coverage and the cost of coverage is below that FPL bar, so yes. Is it correct to offer to the employee only versus employee and dependents? It is not. So again, the employer mandate requires an offer of coverage to the employee and child dependents, not spouses, but child dependents. So it would violate the mandate to offer coverage to just the employee and nobody else. Okay, moving on.
Looks like one more came through the chat.
Oh, it's in the chat. Okay. How do you incorporate employees that receive a health and welfare rate? In our case, 422. So I'm assuming that this is a question about a prevailing rate job, if I have that correct. So Anthony, I'm going to ask you to contact me about that question after the webinar. It's a little bit, it's not entirely out of our scope, but I do want to get some more details and ask you a couple of questions about your question. So let's chat after. Okay, thanks. Okay, so here's number 5. Employees eligible the entire year, waived coverage. The cost is $115. The employee had a qualifying event and added coverage on July the 1st. So here's that form. We're no longer making a qualifying offer of coverage, so we're back to code 1E. The cost of coverage is $115. Those two conditions are in place for the entire year. And so now let's look at line 16. So 1E is now paired with 2H, which is the Affordability Safe Harbor code for rate of pay safe harbor. So this employee is offered coverage. It costs $115, but they waived coverage, and the employer is demonstrating to the IRS that the employee waived coverage. However, our coverage offer was affordable because it met the rate of pay affordability safe harbor. That's why you use code 2H here. Then in July, the condition changes, the employee enrolls, and I think we all now know that 2C means the employee is enrolled in coverage. Okay. Employees eligible the entire year is enrolled in coverage that costs $50 and is covered the entire calendar year. How's that form? This will be one of the simplest forms you ever fill out, and that's the form right there. And again, so we're using the 1A because the cost of coverage is below that FPL number. There's no data on line 15. We don't put 50 on line 15. And we have this, again, optional code 2C on line 16. This would be a completely accurate form if all you saw here was 1A on line 14. Employee eligible the entire year, waived coverage that costs $75 on a calendar year plan. Employee had a qualifying event and added coverage on March the 1st. Really kind of the same example as the last one. Again, you have your 1A code here. You have no data on line 15. There's no safe harbor required on January or February because you're doing a qualifying offer of coverage. There's no data required here. I don't want it shouldn't be here, but the employee is enrolled, and so now we're voluntarily putting in the code 2C for the month that the employee is enrolled. Any questions about why January and February would be blank? Okay, moving on. Okay, employee hired in April, enrolled in coverage that costs $125 for employee-only coverage in a calendar year plan. Again, this is fairly straightforward. Then now we see a more filled out form. The months of January through March, 1H, no offer of coverage, paired with the reason why, 2A, the employee is not employed by you, totally valid. Then in April, something changes. The employee is working for you now. There's no offer of coverage, though, because the employee is in your waiting period, code 2D. So no offer, waiting period, no offer, waiting period. Then in July, we have the offer of coverage, 1E, the cost, and then the employee enrolled, which we all now know is 2C. And that condition remains the same for the balance of the year. This is a pretty typical 1095 for an employee that comes on board, or either comes on board or leaves your employment mid-year. This is pretty typical. Let that sink in for a second. And you will have all of these slides as a reminder, and you'll have all of these sample 1095s as a reference. So here's an employee hired in July, waived coverage. So pretty much the same kind of a form. where you've got 1H2A, 1H2A, and then your 1H2D for the waiting period, your 1E, the cost of coverage, but now instead of 2C, the employee waived coverage. So again, you're demonstrating to the IRS that the employee did not enroll, but your offer of coverage was affordable based on rate of pay safe harbor, and rate of pay safe harbor is code 2H. Pretty straightforward. Okay, 10. The employee hired in February enrolls in coverage. It's 110 per month, and then the employee leaves employment in the month of October. What's that form going to look like? So here again, we have no offer of coverage in January because they don't work for you, 2A. Here's your no offer of coverage. The employee is in their waiting period in the months of February, March, and April. And here's the employee with the offer of coverage as of May. The cost of coverage, they're enrolled, 2C. And then they terminate in October, on October the 5th. But again, we know that insurance coverage remains through the end of the month of termination. So we still are using 1E and 2C for October. Now the employee doesn't work for us anymore. We're back to 1H, no offer of coverage, paired with 2A, the employee is not employed. A really typical 1095. Okay, employee hired in May, waives coverage, costs $125, and he or she is fired on Christmas Eve. This is not a very nice employer. Again, we got 1H2A, not employed, 1H2D, no offer because of the waiting period. Offered coverage, it costs $125. We have our safe harbor code for rate of pay safe harbor 2H, and that condition remains through the end of the year. And again, even though the employee is terminated mid-month, the offer of coverage is valid through that entire month in terms of compliance. Okay, here's the part-time, full-time question that came up before. So this is just a little bit reversed. So you asked the question, what if someone's full-time and then goes to part-time? This is if someone's part-time and then goes to full-time, but the codes will be the same, just in reverse order, okay? So if someone's hired part-time in January, they're promoted to full-time effective May 1st. We have a cost of coverage of $125, and we have the employee enrolling in coverage. So here, instead of 2A, this employee works for us. They're just not eligible for coverage. So now they're going to get code 2B, which means the employee was not a full-time employee for that particular month. I didn't highlight that Series 2 code when we were back looking at a sample of all of the codes, but this is one of the possible codes to use if you have a part-timer who's going to be receiving a 1095-C. And let me just talk about that really briefly. So the only people that receive the 1095-C are your employees that had full-time benefit eligible status at some point during the tax year. If you had a part-time employee who never reached full-time status and never reached benefit eligible status in the tax year, they do not receive a 1095. It's only people that reached full-time status. So in this case, even though the employee was part-time for part of the year, they get a 1095 because they became full-time at some point during that year. So here we have 1H, no offer of coverage, part-time through April. Then they transition to full-time. The waiting period applies. So now it's 1H, no offer of coverage, 2D, they're in the waiting period, and now they enroll. So we're back to 1E, offer of coverage, 125 is the cost, and 2C, the employees enrolled. The person that asked the question about part-time, full-time status, is there any other questions about this? Okay. Another part-time situation, part-time in January, promoted to full-time in March, 125 cost. The employer's insurance renewal is in September and the cost changes. The employee is enrolled, however, and stays enrolled. How would the 1095 look? This is basically the same form as we just looked at. However, I'm giving this to you as an example just to be cognizant of the fact that when you have a change in your insurance program mid-year, it's likely that there's a change in cost to the employees. Whatever system you're using for your 1095-C reporting has to be programmed to know what that change is. So here we have a cost of coverage of 125 through August, but then that changed as of September. The system has to have this data so that this number is properly populated. The rest of it we've already pretty much covered. 1H, 2B, the part-time employee code, waiting period code here, and then 1E, the cost of coverage in 2C. Okay, a couple more of these. Employee hired March 10th. The employee waives coverage. It costs $180 per month for the employee-only coverage. The employee is termed on September 5th. What does this form look like? And the hint here is that the employer is using rate of pay safe harbor and the employee is earning $14 per hour. What does this form look like? So here we are pretty much now accustomed to 1H, 2A for the months the employee is not employed and 1H, 2D for the waiting period months. But now here the condition has changed and the employee is eligible for coverage. They get their offer. It's $180 per month. I'm going to come back to June and September in a moment. And then after the employee is gone, we're back to 1H, no offer because 2A, the employee is not employed. And this also goes back to, I said the codes tell a story. So this is the story of these employees. They didn't work for you. Now they work for you. They're in your waiting period. They receive an offer of coverage, and then something may change along the year. That's the story that these codes are telling. But I want to talk about these empty boxes for the month of June, July, August, and September, why those boxes are empty and why they have to be empty. So remember that you must make an affordable offer of coverage. And in this situation, $180 is not affordable. It exceeds the rate of pay safe harbor for this employee because when you calculate $14 per hour times 130 times 9.83%, you get $178.91. 180 is more than that. So this offer of coverage is not affordable. Because the offer of coverage is not affordable, you cannot claim an affordability safe harbor on your 1095-C. You have to leave those boxes blank. You can only populate a safe harbor code if it actually is truly an affordable offer of coverage. Now, an option for this particular situation may be to switch over to W-2 safe harbor. We would have to take a look at your earnings information across all of the population, but then remember that you have to use the same safe harbor for all employees within a class. So if we did change this safe harbor for this employer to W-2, we'd have to do it not only for this employee, but also for everybody else, which would potentially create changes to all of the other 1095s because the code for W-2 safe harbor is different than the code for rate of pay safe harbor. Any questions about this before I move on? All right. And next to last here, for this purpose, we're going to assume that the employer is actually using W-2 affordability safe harbor. I'm not going to make you do math. I thought about it, but I think that's just mean at this point, so I'm not going to make you do math. I'll just show you the form. So here's the form. We're used to most of this now. No offer of coverage, not employed, the waiting period, months, and then here's the offer of coverage, 175. And if you had done the math, you would know that 175 for this situation is affordable for this employee. So now we have our 2F, which is the Affordability Safe Harbor code if you're using W-2 Affordability Safe Harbor. And then again, we have the 1H2A, no offer, not employed for the last 3 months. Here's a variable hour example. I do want to make sure that anybody who's using variable hour employee tracking pays very close attention to this. A variable hour employee here is hired in 2020. Their measurement period ends in May. They're eligible for coverage. They enroll in coverage, but then the wrinkle here is they then have a reduction in hours to part-time status mid-year. What happens? And I'm just going to go into this really quickly here because we're getting short on time. So note here that the 2Ds extend way beyond what you would normally see for a 60-day waiting period, but that's because this 2D signifies that this employee is still in their measurement period. So this is all accurate, but now their condition changes as of June. They are now an eligible employee. They get their offer of coverage. It's 120. They enroll. This is a correct form for this circumstance, even though the employee's hours have now reduced to part-time, and that's because of the way variable hour employment works. If you are a variable hour employee and is subject to the 12-month look-back tracking and you measure eligible for coverage, for the next measurement period, you are now in stability and you are locked into your eligible benefit status for the remainder of that next measurement period. That's why even though this employee's hours of service are below full-time status, they still get to keep their insurance. Any questions about this concept? Okay. Lastly is a union example. If you are a contractor that employs full-time union members, here's an example of a contractor that makes a contribution to the union plan. The employees are employees of the contractor, but they get their offer of coverage through the union multiple employer welfare plan, or a MIWA. So we have an example here. Joe's hired on March the 15th. He's employed by the contractor for the balance of the year. How does the 1095-C look? I think this may address the question that the gentleman asked about the $4.22 contribution. So correct me if I have this right. But here's the situation. So again, 1H2A, the employee is not employed, but now he works for the employer, the contractor employer, but he's getting his offer of coverage from the union, not from his employer. So the codes on the form look a little weird, but they're accurate for this situation. So as the employer, the contractor still is not the one making the offer of coverage. So it's correct to put 1H in the month that this employee works for the contractor, even though they're getting an offer of coverage from somewhere. It's where they're getting the offer of coverage, which is the key to this, and that's the union. Code 2E is a special transition code where union contractors are allowed to take credit for the offer of coverage made by the union as long as a couple of things take place. Number one is that the employee is offered coverage, number one, and number two, that the contractor employee makes a contribution towards that union plan. And that may be where the $4 question came up, is that contribution to that MIWA plan. Question about variable hour employment. If a variable employee enrolls and his hours are reduced to part-time, is the employer still required to partially pay for the employee's coverage? So yes, so that's that stability period issue where if a variable hour employee measures eligible for coverage and they're in that stability period, that eligibility status is locked in for that entire stability period, regardless of their hours of service. And variable hour employment is a complex concept, and there's a lot of different rules and ins and outs on that. So if you want to have a deeper discussion about variable hour employees and how to handle them, contact me after this, and we'll have that discussion. Okay, The last thing I want to do is throw very few, 5 in total, 1095s that have some errors in them. And I'm going to have you take a look at them, see if you can spot the errors, and then we'll talk about where those errors exist. And so here's the first one. Take a look at these codes and tell me where you think this 1095 is wrong. Actually, what I should be asking is, should this 1095 exist? And the answer is no. This was an employee that never reached full-time benefit eligible status, and so they do not receive a 1095. I often see vendors that produce 1095s for non-eligible employees. It's technically incorrect. They should not receive a 1095. Yes, we will be sending out a link to the recorded presentation, and you will have all the slides, and then please call me after this if you have any other questions. Okay, take a look at this form and let me know if you see any errors. This should be fairly obvious at this point. So this is a qualifying offer of coverage. There's 2 ways this form might be in error. So actually, no, there's 1 way, I'm sorry. So you've got the code 1A, which is a qualifying offer of coverage with a cost of coverage of $150. So we know right away, because of that cost of coverage, that this is not a qualifying offer of coverage. That 1A should not be there. I would expect to see 1E, not 1A. Question, if you previously used W-2 safe harbor and we changed to rate of pay safe harbor, is that a red? No, it's not. And you can change your safe harbors year to year with no problems at all. It's not a red flag. And often I have clients where their cost sharing changes such that they need to look at different affordability safe harbors. That's totally fine. Okay, a couple more here. What's wrong? What's wrong with this form? One H2A looks good. 1H2D looks good. 1H, oops. What's happening in June through August? We have 1H, no offer of coverage, paired with a cost of coverage and that the employee is enrolled. So you can't have a no coverage offer situation where the employee is enrolled in coverage in that month. Both of those things can't be true. So that's an error on this form. Oftentimes this is inaccurate HR data that's in the system, whatever system you're using. The systems that populate these forms are all driven by HR data. That HR data has got to be really crisp and accurate, and that can lead to these kinds of errors. And I think 1 more, maybe 2 really quickly, and then we'll have some time at the end for a couple of questions. So here's a form with some errors. Can you spot the errors? So 1H2A looks good. 1H2D looks good, and then oops, here we go again. No offer of coverage, but the employee is enrolled. That can't be true. Both of those things can't be true. So this would be an error. You'd want to correct most likely the offer code on line 14 after you verified that the employee was in fact enrolled insurance in June. So this form has a whole bunch of errors on it. Can you spot what those errors are? There's actually 3 separate and distinct errors on this form. So the 1E and 2A, you can't make an offer of coverage to an employee that doesn't work for you. So that's an error. If you look at May and June, that may be accurate, except what's the 1A? So there shouldn't be 1A with a cost of coverage of 150. What I meant when I was saying that might be accurate is in the safe harbor code. That might be an accurate safe harbor code, but the offer code of 1A is what's the problem here. And then again in June and July and August, you've got 1A, qualifying offer of coverage with a cost of coverage that's well above that. And then you've got a mix of safe harbor codes on this form as well. You've got 2H, 2F, 2G. You can't mix in different safe harbor codes on a single 1095. And likewise, September and October, we have no offer of coverage, but if the employee is enrolled, that can't both be true. The only month that works on this form is actually, can you see it? It's December. No offer of coverage because the employee is not employed. That's the only month on this entire form that has coding that makes sense. Okay, so takeaways from today. Again, thank you for your time. Thanks for taking time out of your lunch. I know some of you had to hop off. You'll get the recording of this and the slides. Be aware that the IRS intends to collect penalties from ALE employers. ACA reporting is here to stay. I often get asked, when's this going to stop? It is not. You've got to treat this like your W-2s from here on out. Make sure your ACA reporting is done on time, that it's accurate. Learn your codes. You've got to learn your codes in order to audit your forms and audit absolutely everything that your third-party vendors are producing. Keep copies of everything for defense purposes and take advantage of us. This is what I do. So I audit this stuff all the time. Send me the stuff, your payroll vendor or whoever vendor you're using. Let me take a look at it and we'll make sure that it's all correct before it goes to the IRS. So finally, we'd like to get some feedback from you. This is our very first round of this particular webinar. I'm going to hand it over to Sarah for a moment to talk about how we'd like to get some feedback from you.
Yeah, thanks, Keith. So I just put a link in the chat to everyone. It's a really quick 4-question survey that I'm hoping you all will take just a few moments to fill out. We know your time is really valuable, which is why we want to make sure that these webinars and any other educational materials we're providing you are really giving you what you need and what you want. So the responses are anonymous, so feel free to share your feedback honestly, and it will really help us provide better material for you all. So thank you very much.
Great, thank you so much, Sarah, and many thanks to Sarah for helping put this webinar together. This stuff does not happen without her and her team supporting me, so thank you so much. I'm happy to hang around for a few more minutes if anybody has any additional questions. I'll let those float into the Q&A box if anybody has any additional questions. Again, you're going to get this recording, you'll get the handouts, and you all know how to contact me offline if you have any questions that come up after the session. And I don't see any questions coming up, so then I will bid you all a very good rest of your afternoon. Happy New Year. Hope this was beneficial, and we'll see you soon.